first quarter of 2021 was all about recovery. The market was up 5%, continuing the recovery rally that we had for much of last year. It was driven by enthusiasm for the economy, the vaccine rollout, which was a little bit slow starting the quarter, accelerated through the quarter, and commodity prices were strong. Unemployment got better. And so the market right now is looking forward to a really strong economy this year, and one that's going to get stronger and be strong for a bunch of years. And the market reflected that. Market leaders were cyclicals and companies that benefit from recovery. And the companies that lag were the companies that did the best last year, those big cap tech company and growth companies. And so there was rotation in the market. Also, the small cap stocks were big leaders. That's usually really good for the stock market. Strong breadth indicates that a rally is going to keep on going. There were lots of companies that helped us, but they tended to be by small amounts. So some of the standout names, ArcelorMittal, which is a European steel company, did very well. We were hurt by the small caps. We were hurt by Walmart. So Walmart had a good quarter, but it was a recovery play. So it was one of those companies that did particularly well last year due to COVID. So one of the things that definitely helped us was that about a year ago, we started getting alarmed by both the valuation of the biggest 5 stocks in the market, which got so big that they exceeded a quarter of the market, which is the greatest concentration the US market has ever seen. And when we get nervous about a risk, in this case, it was a crowding risk or a concentration risk, we started to sell down those stocks. And we saw opportunities in cyclicals at that time. And there were some really good high quality companies that were inexpensive and had really good outlooks. And so we shifted about 3% of the portfolio out of the big cap tech companies and into the cyclical stocks. And that's something that's really been helping us as the quarter has gone along. I think that inflation is going to be rising over the next several years. And when I look at how appreciation performs, on those days when the cyclicals and the inflation type stories do well, appreciation is outperforming. And on days when the COVID beneficiary stocks outperform, or the really big cap growth companies that are expensive outperform, we lag. And since I think we're heading into a period where inflation is going to be moving up over the next few years, I think that indicates that we're very well positioned. Now, what we're seeing here is a very strong and accelerating economy right now. Forecasts are out there for 5 to 7% increases or even more this year, which is very powerful. We're seeing some inflation in a lot of the commodities, more due to supply disruptions and transportation disruptions than due to anything fundamental. There's still plenty of capacity out there. And the labor markets are still very loose, although beginning to tighten a little bit. And so what we're looking for is low inflation right now, accelerating over the next couple of years. Because labor markets are so loose, it's really going to be hard to see material inflation in 2021 or even 2022. That said, it's going to pick up. The Fed's going to have its way. And so it's important to make sure that your portfolio is positioned to benefit for that.